Welcome back to this very special Indianomics. We are calling it the Money Masters. I have with me the creme de la creme of India's treasuries, Mr. R. Shankar Raman of L&T, Mr. Srinivasa Rangan of HDFC, and Anant Narayan of Standard Chartered Bank. Well, we now discuss the cost of money. Anant, once again to begin with you, we have seen a fairly dramatic and unexpected fall in the cost of funds. If I take the 10-year from about 7% at the start of the year, we are now to 6.7. If you take the old 10-year, if you take the new 10-year as well, it's a good 30 basis, over a 0.25% fall in the cost of money. If you take probably a 1 year or a 1.5 year view, I think the cost of funds are even 200 basis points. So where are we headed to start with? Anant, do you think there is more to go in terms of fall in the cost of money?
Well, Latha, I think given the way CPI surprised all of us, and now we expect the next month's print to be even below 2%.
2 months print is expected to be below 2%.
And given the fact that our monetary policy framework is reasonably straightforward, i.e. it's a lever of watch the inflation and react with interest rates, I think there is a high probability that the RBI will oblige with rate cuts in the August policy. And maybe even beyond that. So 25 to 50 basis points of rate cut cannot be ruled out. But, you know, I do like to go beyond just interest rates and inflation. I think the economy consists of lots more beyond that as well. There are lots of factors which support short-end rates to be lower. Credit offtake still remains tepid, despite the fact that debt capital markets are doing reasonably well. Rupee, as we discussed, is probably on the overvalued side, which again calls for short-end rates to be on the lower side. CPI, of course, inflation, I think, is a strong case as well. And the fact is, you know, the domestic industry on the micro level is not necessarily doing well. No. So maybe spurring some amount of consumption, some amount of banking health through short-end rates can also be argued for. At the same time, there are vulnerabilities on the longer end, which I think we need to be cautious about. First is state government finances. The fact that we are discussing, farm loan waivers, you know, they have very strong social requirements and reasons for doing that, but there are implications in terms of the fiscal health of the country, etc. And the second part, which kind of worries me a little bit, is the fact that we are seeing so much of money move as savings into equity markets. Who am I to judge where equity markets are headed? But the fact that post-tax returns on deposits have come down to a particular level, which encourages people to passively put money in SIPs and whether the capacity for the equity markets to hold that kind of money is there or not, is, I think, a bit of a vulnerability we have to worry about. So all in all, I think there is a strong case for short-end rates to come down, give a fillip to domestic industry. I'm not so sure, though, that this should be complacency in the longer end. Given the external situation, given the vulnerabilities building up in the economy, maybe there is a case for longer end rates to be on the higher side. A steeper curve, I think, would be perfect. Okay.
That's not a very happy situation for the NBFC and the manufacturing company. Mr. Rangan, what's your estimate? Do you think that there is a case for longer-term rates to fall? There is necessity for long-term money to fall, cost of money to fall. Will it fall?
No, two questions you have asked. Basically, you are saying whether the long-end rates will fall. The answer, the simple answer is...
Should the 10-year go to 6?
So the simple answer to that is obviously the macros. I mean, if you really trace all the macros, whether it is CPI or whether it is flows and other this thing, there is enough reason to believe that the GSEC has further room to actually fall. Whether it is 6 or 6.25 is, most of the bankers we ask, they probably would be talking on a 6.25 type of a rate, somewhere in the near future. But if you were to talk about whether interest rates are going to make a difference, whether it is 25 or 50 basis points from here on for the type of, projects and others which you are talking about, I would think that the investment into new projects is going to come in only when we are going to see the existing capacities being fully utilized. Today, the capacity utilization is on average between 50 and 60% in most of the industries. And as you also mentioned about the banks, they have a lot of infrastructure assets already, and they are, they have to solve a lot of the whole problems. So, I mean, given that the credit offtake will probably start happening when we see some of the reversals in these capacity utilizations largely, the requirement even to have a long-term funding for some of these projects, I don't think the market is really, you don't see many people coming into the market and asking to raise long-term money for putting up a new project. It's either refinancing largely or it is largely the consumer-driven businesses, whether it is housing loans or those types of businesses, which are continuously, in the longer end to pick up, money as
everyone is looking at your sector to probably break that log jam, that if enough houses are demanded and built, then probably that will lead to a consumption and therefore an investment cycle kickoff. But you are actually looking at the capital goods guy to
even if you look at our sector, for example, to be very honest about it, if you look at the housing finance, which is a sort of benchmark for the real estate activity.
You don't see the cost of money falling?
Cost of money is coming down, and obviously it's a financing business, so as the rates come down, you pass on the benefit of this thing.
Can't it not be a kickoff for further demand, housing finance?
To some extent, yes, but
if it came down to 7, that's what happened in the previous cycle.
Today, if you were to look at the current interest rates and try to put all these CLSS subsidies and tax benefits and whatever it is, I think you are almost at the 4% type of real effective interest cost to anybody. I think it's quite that way very attractive at this point in time also. But having said that, whether it can go down further, probably yes. But if you look at even at the current juncture, the average growth of most of the HFCs have been around 18 to 20% on a book basis, particularly the larger ones. So there is a real activity which is happening there, which is obviously keeping the balance sheets to grow. The assets have been remained, broadly, well in terms of collections and all that stuff.
Okay.
But I think the capex segment and others is where I think the large part of capacity and utilization is lying.
Okay. Well, that is a larger question. But Mr. Shankar Raman, I primarily want to ask you whether you see, masala bonds and domestic interest rates altogether making cost of money easier for India Inc. in general. Will FY18 be the year where that will be the positive side of P&Ls?
I somehow believe that we are almost at the bottom of the cost of money debate. I don't really believe that there's going to be a big downside to interest rates from where we are today. 2 reasons. One is I think we have sort of caught the tiger by the tail in terms of farm waiver, loan waivers. Okay. And several states are coming up for election, and even those which don't have election will have the farmer agitation coming up. The government possibly in the run-up to the FY19 election will have to deal with it in a very sensitive manner. And I do believe that that is going to create some unexpected holes in the government's balance sheet. Okay. And secondly, the banks which are sitting with money are also sitting with huge amount of non-performing assets. Yes. And these were the very accounts where the banks were happy to lend, let's say 5 years ago or 6 years ago. So there is a structural issue here about banks having money but not wanting to lend to people whom they lent earlier. So who are the new guys who are going to put their hand up and claim money? The
consumption? No.
So the consumption cycle is what possibly will pick the investment, because consumption, hopefully this festival season on the back of maybe reasonable monsoon, should be able to see the consumption pick up, and that could lead to some capacity utilization improvement. And if the government does go forward with the infrastructure build that they are talking about, I expect steel and cement to also lead the way along with construction machinery.
But basically, coming back to my fundamental question of cost of money, you are not expecting more than perhaps a few basis points?
Yeah, there would be some marginal correction perhaps, depending on the demand-supply situation. But I don't expect that to be significant for corporate India to change or refashion any of their current plans.
Okay. Well, we are at the half-year mark, June 30th. Let us foregather next June 30th and see whether a structural shift has happened and both dollar and dollar rupee and interest rates are much lower. Perhaps someone who had met in 2002 and then in 2004 would have been surprised at the kind of fall we saw. Maybe we are in that same inflection point, or maybe we are, this will also pass. And what you say is true, that interest rates would have troughed out. That will be an interesting debate to see. Thank you very much for joining us in this edition of Indianomics.